If you're interested in investing with exposure to the markets, but fear the potential risks that come along with it, I'm here to tell you about a possible alternative to stocks, bonds, mutual funds, and GICs. That's structured notes. Structured notes are investments that provide market exposure and can embed some degree of downside protection, depending on the type you choose. Notes can be linked to a variety of underlyings, including benchmark indices like the S&P 500, or a portfolio of shares. They can offer a variety of different payouts, including ones that provide periodic cash flow or a pure growth option. With so many options to choose from, you can select the note that has the amount of downside protection you're comfortable with. And the different levels of protection can range from 0 to 100%. 100% means no matter what happens to the market, your original investment is protected if held to maturity. 0 means you have full downside risk if the market goes down. That's like your investment in stocks today. If you're buying a note that offers less than 100% protection, as long as the market doesn't go down by more than your protection level at maturity, you know your investment will be safe. And if the market goes down further than your protection level at maturity, then you could lose some or all of your original investment, depending on the extent of negative performance. Downside protection. Sounds like a nice feature, right? But you're probably wondering how this impacts your upside potential. On the upside, notes have a couple of features that make them different from a direct investment. They can include a performance cap or a reduced participation rate that could limit your return relative to a direct investment. They're also term investments that should be held for their full term, typically 5 years or less. So although these features make them different than a direct investment, they're also the features that allow the principal protection feature to be available. As with all investments, it's always important to read the terms of the note so you know and understand what you're buying. If you're buying a principal at risk note, you could still lose some or all of your original investment if the market goes down more than your protection level at maturity. And if you're buying a principal protected note or a market-linked GIC, they offer upside potential, but there is the possibility that no return is paid for the term. That's based on market performance and something you need to think about versus buying a GIC or other investment that offers a guaranteed return of some kind. You also need to know that market-linked GICs are non-redeemable, and that market-linked GICs are eligible for CDIC insurance up to applicable limits, whereas principal at risk notes and principal protected notes are not. There are a lot of options and a lot of great information available about structured notes.